Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And today's video, we're going to do the video that you voted for. Number one, why is dividend investing, or dividend ETFs rather, losing to S&P 500 covered call ETFs? When it comes to dividends and dividend investing, we know that that is, a very popular type of investing. It's a very popular source of passive income, right? Buying dividend stocks, right? When I say dividend investing, I mean dividend stocks. You're buying stocks that give a dividend, which we all know is a share of the company's profits. And of course, for this exercise, I'm not going to be going into individual dividend stocks, just ETFs. And we're going to, for this purpose of this exercise, for me to show you and prove to you that it's losing versus covered call ETF investing, we're going to take some of the most popular ones. So of course you have SCHD from Schwab, right? The US Dividend Equity ETF, which is an ETF that holds many quality dividend stocks. But there's plenty of other ones. You have VIG, the Vanguard Dividend Appreciation ETF. And by the way, in case you didn't notice, this is on the American stock market, okay? This is dividend investing on the American stock market. You have VYM, right? Also from Vanguard. You have this one here, SDY from Spider, DVY from BlackRock. So there's all kinds of US dividend ETFs out there. They're very, very big. They have a lot of AUM. And if we just compare the ones I showed you real quick, SCHD versus VIG versus VYM, SDY, DVY, it seems to me that the clear winner in terms of total return seems to be VIG. This one here, the Vanguard Dividend Appreciation ETF. And when you see something like Dividend Growth or Dividend Aristocrats or Dividend Appreciation, it means they're really focusing on dividend stocks that tend to grow their dividend or appreciate their dividend over time. But in terms of total return here, you see that, an SCHD, very, very, very popular. You can actually see the total returns 1 year. SCHD is really falling behind compared to VIG. VIG is a top performer. 10 years, of course, we're long-term investors. That's what we're interested in. 11.52. So VIG, to me, if we're doing the comparison, seems to be the winner here in terms of total return. You'll also notice the total return versus the actual S&P 500, and that these dividend ETFs are not beating the S&P 500 at all at any point of time, I don't think. Like you see the last 10 years, you see the S&P 500 is ahead in terms of average total return. Right, in the last 3 years, the last 5 years, it seems like the S&P 500 is always outperforming. And so for the purpose of this exercise, I'm going to be actually comparing or doing some total return comparisons of S&P 500 income-oriented covered call ETFs in a second. But I'm going to do the comparison versus VIG, because VIG seems to be the best, or in terms of total return, one of the highest. And by the way, VIG only has a distribution yield of about 1.69% or 1.7%. SCHD is a little higher than that, is a little under 4. But again, total return comparisons, I'm going to be doing it to VIG because it's performing better. But if you're interested in looking SCHD versus VIG, you see that it's fairly close in the last, this is 14 years of data. You see that the average total return are very similar, but VIG is pulling ahead. But if we just change, by the way, this is just extra information, but I thought this was very curious. If we just do SCHD versus VIG starting in just in the last year or so, you see that VIG is pulling ahead by a lot. And at the end of the video, I'm actually going to try to answer the question why that is, because it's all going to make sense to you. But first, let's actually do the comparison versus what I feel are the top 3 S&P 500 covered call ETF. So these ETFs, everyone, that I'm about to show you, GPIX, SPY, and T-SPY, I feel are some of the top S&P 500 covered call ETFs on the US market. What they do is essentially hold the S&P 500 and they're writing call options to generate income. So not only do they have much higher yields than dividend ETFs like 4% or 2% or whatever they are, 3%, 4%. So for example, GPIX, the distribution yield, the dividend yield is approximately 8% a year. It's a monthly dividend also, not a quarterly one, a monthly dividend. It's fairly consistent. The management fee is actually very nice at 35 basis points. Of course, it's higher than those dividend ETFs because writing call options is more costly to manage. But you could check it out yourself. I don't want to do a deep dive in each one because I cover these in detail on my channel. And by the way, if you're interested in income oriented stuff, passive income, ETFs, this is the channel, guys. Hit that like button, subscribe to the channel. So I just want to show you that the monthly distributions are very, very, very stable, and they're typically around 8% for GPIX, 8% annual. For SPY, similar thing. It holds the S&P 500, writes call options. The distribution rate or the dividend yield is actually definitely higher for this one. It's usually around 12%. And again, the monthly distributions are fairly, very consistent. So you're looking at about 12%, 12.5% for SPY. And T-SPY is a newer one that came out, which focuses on doing daily covered calls. And this one, the yield is typically around the 14.5% yield mark. It's about to celebrate its 1 year, I believe. But it also has very consistent monthly distributions as well. So I really did it on purpose to choose what I feel are the 3 top ones with very consistent distribution. So you have, again, GPIX with about 8%, SPY 12%, and T-SPY about 14%. So yes, the dividend yields, the distributions yield are much higher than dividend ETFs. But what about total return? What about total return, which includes everything and it's net of fees? Well, let's do it, guys. For this exercise, I just chose SCHD and VIG. If we do the total return comparisons, now none of these 3 ETFs have been out for 3 years, but we do have at least 1 year of data. And you could see that GPIX and SPY, in terms of total return, so that's dividend and NAV and capital, are outperforming VIG and SCHD. You could see that, right? So they're a lot closer to the performance of the S&P 500. Now, I don't have a year of data for T-SPY, but for example, if we just do VIG versus T-SPY, I'm choosing VIG because it's it's a higher performer than SCHD. You see that T-SPY is outperforming VIG as well by quite a bit here. You're looking at 9.85% total return versus 7.94. Again, this is with dividends reinvested. But even if you don't reinvest the dividends for T-SPY or VIG, and you still count the dividends as cash, you see that T-SPY is still outperforming the VIG, right? So I think I've proven my point here to tell you that in terms of performance, and you could go on this website and do multiple performances, analysis. If you do VIG versus GPIX has been out for over a year. You see that it's fairly close, but GPIX has the advantage, guys, with dividends reinvested or without reinvested. So the GPIX has much higher yield, has a higher management fee, but it's outperforming VIG. So I feel personally that investing in an S&P 500 covered call ETF is far superior than investing in a dividend ETF. But the $1 million question I want to ask now is why? So first of all, the first thing I will show you is that the S&P 500 is outperforming like all the dividend ETFs, and you see that VIG is outperforming SCHD by quite a bit, especially lately. I found that was very interesting. Keep that in mind. If we do since inception, not that much, but if we just started at the beginning of 2024, why is VIG and outperforming SCHD so much? And then why is dividend investing not beating the S&P 500 covered call ETFs? Well, the answer is pretty much the same, or my theory is pretty much the same to all 3 of these questions. It's because when you're investing in a dividend ETF, guys, like SCHD and VIG, the ETF could only choose to put dividend stocks in there. So some of the top stocks in the last 5-10 years in the overall US market have been growth stocks, have been stocks that don't have a dividend, or that have a very tiny dividend, which has just been put in place. So of course I'm talking about things like Nvidia, the Magnificent Seven, Amazon, Tesla. These have been some of the best performing stocks in the last decade, right? We've all heard of the Magnificent Seven, but these are typically not in these ETFs. In these ETFs, you typically have value stocks, because value stocks are the ones that typically give dividends. So of course you're going to have some technology stocks. Some technology stocks have small dividends, but you're going to have more value stocks here like AbbVie and Pepsi and Coca-Cola and Merck and more energy and financials, right? If you look at the sector mix, you see that information technology, which is by far the best performing sector in the last decade or two, is very underrepresented in SCHD. And this is my reasoning of why SCHD is really underperforming not only the S&P 500, but S&P 500 covered call ETFs as well, like I've proven to you. And I think there's another question: why is VIG beating SCHD so badly, especially lately? Well, if we look at the composition of VIG versus SCHD, I've noticed that something very interesting: tech makes up a huge chunk of VIG. So my theory is that this is why VIG is greatly outperforming SCHD. It has a lot more tech stocks. We know that Meta, Microsoft, Apple, they're considered tech stocks normally, but they even Nvidia, they have a tiny dividend. So I guess they were able to add them in here. But my overall theory and premise is that I think this is going to be a trend that's going to accelerate over time, where dividend investing, specifically investing in dividend ETFs, is not going to beat, or never going to beat, the overall market, because essentially you're giving up the growth stocks. The growth stocks are not in here. So in my personal opinion, and just like I showed, if you're interested in income and passive income, you're going to be much better off with an S&P 500 covered call ETF, because this has the actual S&P 500. Right? So not only are you getting 5, 6, 7 times the yield of a dividend ETF, you're getting the whole S&P 500. You're actually better diversified, and you're getting the yield 8%, 12%, 14%, and you're getting better performance. And I think that's only going to accelerate, because I think technology stocks are going to be the best performing stocks. This is my opinion, guys. The disclaimer, not financial advice or anything like that. This is just my opinion. They've been the best performing sector in stocks in the last 10, 15 years, and I think that's only going to continue. And a lot of them don't have dividends, because tech stocks typically reinvest their profits into more research and development. So I think this trend is going to continue. So guys, it's clear indication that dividend investing is losing versus covered call S&P 500 investing. And you have the proof here in the pudding, guys. You could run the numbers yourself. So if you're more of an old school dividend investor, and I'm not saying there's anything wrong with investing in a dividend ETF. They're obviously very, very popular for a good reason. There's many of them. I'm sure I missed a few of them. There's plenty of them on the US market. But if you're investing in these because you want passive income, and lower volatility, even lower risk, you're actually much better off with just an S&P 500 covered call ETF, because you're getting more diversification. You're actually getting the whole S&P 500. You're going to get better yield, better income, and better performance. And when you're writing covered calls, when you're doing a covered call strategy on something, you're actually lowering the risk. Right? So holding GPIX or SPY-I or T-SPY, believe it or not, is actually lower risk than owning VOO or IVV, the S&P 500 itself. So give me a thumbs up. I'd really appreciate if you learned something from this video. What do you think about dividend investing in the US? Do you think it's gonna start to fall out of favor? Do you think these covered call S&P 500 ETFs, which is, I just showed 3 of them, but there's dozens and a lot more. What do you think about that? If you're new to high income covered call ETF investing, this is definitely your channel. You guys know, or in case you didn't know, every single month I have a monthly series where I review all the covered call high yield ETF landscape in the US and in Canada. I have 2 separate videos, 2 separate episodes. And in case you're American, you don't care about my Canadian content, I have a specific playlist just for US content. Give me a thumbs up. I'd really appreciate it. Let me know if you have any questions, any concerns in the comment section below. And thanks for watching. See you next time, everyone.